All right. Thank you very much, Liz. As John Cunliffe used to say, there is one thing worse than speaking after lunch, it's not speaking at all. So I will try to make this as lively as possible. So, and trying to also explain a bit more what we have done here. My name is Diego Valiante. I'm head of financial markets and institution research at the Center for European Policy Studies in Brussels. But as Luis mentioned at the beginning of his intervention, I will be leaving soon SEPS to join the European Commission precisely to work on these topics. Now, we started about around the end of 2014, an experts group of about including experts and policymakers and academics, including Marco Lamandini and others, on the issue of so-called capital markets union. And I'll try to explain to you what it actually is. And we produced this report, which is about a 300 pages book on the various barriers to capital markets integration. And in fact, this is a sort of barrier removal plan that we propose to the Commission, where you have essentially 36 barriers and 33 policy recommendations. Now, starting from here, I would like to convey the message that you should look at the capital markets union at least in 3 dimensions. There is a dimension of financial stability, and I will explain to you what we think financial integration is and how developed thanks to the euro and how we should look at financial integration after the capital markets union. There is an efficiency element. So you know that capital markets in Europe today are very fragmented. Typically, I mean, you can see the European capital markets as an emerging market to some extent. And there is a cohesion problem, or cohesion issue, which refers to the link between the euro area and non-euro area countries. This is a multi-currency project, and I will explain you why. Now, on the financial stability part, let me start by setting a definition. There is no one single definition of financial integration in the academic literature, and you'll be surprised because it's a very important topic going on for almost 60 years, at least in the European Union. So we try to come up with the definition, and we define the financial integration as the process through which different regions or countries become more financially interconnected. This involves the free circulation of capital, services, and it usually determines 2 things. A price convergence, so a convergence of asset prices across all asset classes, and a second aspect, which is an increase of capital flows across these regions, so-called private risk sharing. So Dutch investors that buy Italian assets and vice versa. Now, these indicators from the European central banks that have been built over the years show the level of price convergence and the level of so-called risk sharing, quantity convergence, so cross-border holdings of assets. Up to 2007, up to the crisis, you have seen, you should look only at the rate of growth, not at the absolute values, because these indicators are not good to measure that, good to measure the rate of growth. The rate of growth of price convergence was much faster, thanks especially to the euro, and up to the crisis, in which we realized that this price convergence, so we have seen this especially in government bond yields, you have seen them spreads going to 0, so German bonds and Portuguese government bonds had more or less the same yields. Then we realized that this convergence was somehow fictitious, because it was not relying on cross-border sharing of risk, but it was based mainly on senior financial claims in interbank markets, which are the type of capital flows that retrench the first when a crisis hit the area. So our financial system wasn't equipped to a structural shock. So with the crisis, you saw a terrible adjustment in price convergence. So you had a huge dispersion of asset prices across euro area countries. So to adjust at the same rate of growth than risk sharing, so cross-border holdings of assets. What we see, though, after the crisis, when the recovery has started to pick up, this divergence again taking place between price convergence and quantity convergence. Again, probably putting down the seeds for potentially another concentration of capital flows somewhere around the euro area. So we need to be very careful when we look at these indicators, make sure that how do we make cross-border risk sharing take place and catch up with price convergence. Just to give you a picture, and I won't say much on this, even though there is a lot to talk about, essentially the risk sharing, so when a crisis hits an economic area, there are at least 4 ways in which you absorb this shock. Private and public savings, public transfers, and this so-called international factor and depreciation income. Now, the academic literature is building more sophisticated indicators, but let's say for the moment these are indicators that are used to assess risk sharing. As you can see in the first bar here, which is the one with the stripes, is the United States. We have updated this data to 2014, but I haven't been able to reproduce them in this chart, so you still have up to 1990, but it hasn't changed. These contributions are more or less the same. So you have essentially fiscal transfers on which we put a lot of emphasis, bailouts, public funds to save banks and so on, accounts only for about 20% of the fiscal absorption, the absorption capacity. So you'll be surprised that actually 80% of the absorption goes outside the direct fiscal transfers. But if we look at the contribution of cross-border banking and capital markets, which is this first bar charts here, you see that in the US contributes for about 40%. In the euro area, it's even less than 5%, and in the European Union is actually negative. Just to tell you that the current financial structure of Europe is actually enhancing a shock. It's not absorbing shocks. And this should tell you a lot, because in the end what happens, that the shocks goes into savings and mostly in consumption, which is the smoothed part. And we had a huge drop in consumption, and this is the story that the IMF goes around telling the whole euro area, that consumption level, so demand, should go back to the pre-crisis level, because it's now too low. But it's too low for one single reason. Our financial system is unable to withstand structural shocks. And in this contribution, again, you have cross-border banking activities that banking union hopefully should take care of, and capital markets activities that capital markets union should take care of. But I will explain you what should the Commission do and what perhaps is not done yet. Now, if we look at the composition of investment flows within the euro area, you can see that, because it's important that you know that there are 2 dimensions. There is a dimension of banking and capital markets, but there is also a dimension of debt versus equity. Debt is much more procyclical. Equity is able to absorb structural shocks. And if you look at the composition of investment flows in the euro area and in the EU, we are at the same level than Japan. Compared to other advanced economies like Canada, United States, and Australia, mainly our capital flows internally are driven by debt, not by equity, while in other advanced economies is actually the opposite. And just to show you how debt behaves during a crisis, this is cross-border debt securities holdings by the MFIs. They have collapsed with the crisis. They have completely collapsed. And if you take the domestic holdings, you would see an offsetting trend. So they have offloaded the cross-border exposure in exchange of a more domestic exposure in that securities, while equity, most surprisingly, has gone up. Equity holdings during the crisis, cross-border equity holdings have gone up just to show that the absorption capacity that equity has. Because of course, if you take a hit of 40% of your value, you might be interested in buying equity because you see only the upside after the crisis. So what is the quality of our equity markets? And I'll get there in a moment and I'll show you what we have. Now, there are many other reasons why we should develop more market-based funding in Europe, and you have an entire chapter of this book which you can download for free online, where we discuss about the effects on monetary policy transmission of having market-based reference rates instead of panel-based reference rates. Access to finance. There is tons of literature coming out showing that there is a very strong correlation, if not causation, between development of market-based funding and innovation and technology, and especially for startup. And in a second life, I'm also involved in a business accelerator. We process about 700 startups every year, and about only 15 get funding. They usually get the first round in their own country because of family and friends. Second round, if there is some private equity funds, which is an exception, only for a few countries. Third and fourth rounds happen in London, so you move the whole company to London. And mostly if they are good companies, so they can go to market, they move to the United States, which means they move with them all the intellectual property rights, all their know-how, move to the US with all the spillover effects that this has positive spillover effects for the economy overseas. Now, these are loss of competitiveness, is a loss of productivity that Europe has at the moment for the lack of equity capital. And again, there's the discussion that also Marco represented in a very nice way of the bank restructuring and how market-based solutions could actually help for that. But that's a long story which I will not discuss today. Now, so this is we have started from a very high level, theoretical level. Now we are drilling down into the details of our financial structure and the barriers. Now, this is the current financial structure in Europe. Compared to other regions of the world, our banking sector is over 300% of GDP. And you can see that the financial diversification of our financial system is as good as the Chinese one. And it's not, in fact, it's not a combination that is not by chance that the most financially unstable areas at the moment are China and Europe, because their financial diversification, the financial stability is impaired by the lack of diversification in the financial system. And in fact, Japan is a case that is similar to Europe in terms of macroeconomic characteristics, low growth, and to some extent a stagnating economy, but their financial stability, their financial system is pretty stable and has been pretty stable over the years because they are much more diversified. Right. If you look at the capital structure, again, the role of capital markets in Europe, if you clean up financial institution debt and government bonds securities, which are essentially most of this column here, and which you should not consider them as a sign of well-functioning market because of why they are issuing this debt, is essentially to face financial difficulties, well, there is not much left. Our corporate and equity bond markets and our equity markets are even smaller than Chinese equity and corporate bond markets, because this number is actually updated to 19%. Now, so I hope I gave you the financial stability dimension of this discussion. Now I want to give you the efficiency dimension. So the issue of fragmentation, the lack of investor choice, the fact that you pay quite a lot to buy investment products in Portugal or in Italy and other countries across Europe, and you might wonder why, and why choice is very limited, not just for investors, but also for funding of businesses. Which today, what is shocking the most is the lack of demand. It's not the credit crunch of financial institutions. The fact that most of the demand of credit is for working capital, and actually demand has been scoring constantly below the expectations of the banking system. Now, I start from this point always, because it's where everything starts. People that have capital, resources that need to be allocated. And this is the picture of European households versus US households. European households on average holds about 3 times more than cash and deposits than US households. They hold half of the investment funds units that a US household holds. We had 30 years of regulation to create the UCITS. First directive was in 1986. And after 30 years, we realized that UCITS are mainly allocated to professional investors. Retail investors are only 20% of the holdings of UCITS. So again, this has not percolated, this type of instruments that should provide diversification to your portfolio has not reached investors. European investors also hold half of their assets, of the shares that the US hold. And I will show you this is very important for the quality of trading flow of equity markets, the retail contribution. Of course, the picture is very fragmented across Europe. I mean, countries like Greece, Portugal, Italy have a lot of cash and deposits. Countries like the Netherlands or the UK have less cash and deposits because of the development of the investment fund industry or the pension fund industry. But what is most shocking to me is this picture, which is the picture of non-financial corporation liabilities and their breakdown. On average, European firms are smaller than US, Japanese, and Chinese firms. And they are smaller by quite some difference, about 40% smaller than US firms. But if you look at the composition of their liabilities, what is the missing element in this picture is the equity contribution, which plays a much bigger role in the US and in Japan. Now, you may wonder it's because of the family capitalism in some countries, European countries, that is not open to market pressure, to the to open governance of firms. I don't know. The question is that this situation it's not helping the economy. The lack of equity in our firms is a real issue, and we should try to find a way to deal with that. Now, if you look at the debt funding contribution, then most of the debt funding is bank loans. About 80% of the exposure towards debt of corporates is mainly bank loans, versus market-based funding, only about 20%, which in the US, of course, is 60%. Now, we're not saying we need to be the United States, because the United States has got its problems, and there's a long list of issues, but I think the answer is somewhere in the middle. And we are not even close to that middle at the moment. So what is the state of our European capital markets, for which we are going very proud of? But I'll show you it's a bit a peculiar situation. Now, this is just a picture that summarizes everything. Just one point I want to make. The single currency reviewing all the literature that's come out since the introduction of the euro, the single currency has played a very limited role in the integration of financial markets, except for some very liquid government bond markets where dealer liquidity the cost of liquidity for dealers went down, and that was a beneficial aspect. The single currency had not much of a bigger role, which means that this is a project that can work in a multi-currency area and actually should work in a multi-currency area. I won't say much about private equity and venture capital. I think I gave you a bit of the picture, but I want to focus on 2 areas, which I think are very important. Our equity markets and our asset management industry, I would say the distribution of investment products across the EU. Now, on the equity markets, just one picture. These are the size of the turnover of European exchanges. This is the turnover of US exchanges. It's just 1/5. Even though our economy is technically bigger than the United States, our equity markets are only 1/5 than equity markets in the US. If you don't have efficient secondary markets, you most likely don't have efficient primary markets either. Because the first thing that a private equity fund will ask before entering an investment, how do I get out of this investment? And if in that country you are dealing with a small, thin equity market, most likely private equity will not access in the first place those investments. And this is the case also of many firms, family firms, like, for instance, Ferrero in Italy, which has been fighting against going to the stock exchange in the last 20 years, precisely because 90% of their income comes from outside Italy. But then you're listing your company in a market that is the size of a peanut compared to the outreach that a company like that has. So this is a serious issue. This is where most of the risk sharing comes from. So it's not from magic monetary policies that risk sharing emerges. It comes out of this type of action. Now again, just to show you how we are fragmented, this is the turnover of our markets divided by geographical location. So you have London, Frankfurt, and Paris. They go completely in sync. This means that there is no competition among the national markets. Even though, if you take this picture, this shows you the market share of newcomers in trading venues. So you have the national market, and then thanks to MiFID, you have now a proliferation of small trading venues that are competing with the national market. On these trading venues, you see that up to the most, these are the most liquid shares of the exchange. Up to the 50th most liquid shares, the market share of newcomers is pretty high and pretty stable. After the 5th most liquid share, they go to zero. It goes to zero almost, the market share. Just to show you that there is a pan-European demand for the top of the book of the most liquid shares. Even though we don't have the infrastructure, even though our markets are geographically segmented, they are not segmented by specialization. So you have the industrial sector, you have the semi-sector. Even though they are split geographically, there is a pan-European demand because these newcomers are essentially pan-European trading platforms bringing institutional investors for the top of the book. So what is keeping us from creating a European listing, blue chip index or exchange to issue shares across the EU. And I'll get you there in a moment. Just to show another picture, just to give you a sense, the contribution of households to equity markets in the US is about half of the whole trading floor. Half. In Europe, it's less than 10%. Just to give you a sense, I mean, we don't have to be like them, but if we get closer, it actually wouldn't hurt us. And the other picture is the insurance and pension funds. This is the EU, this is the United States. Besides the absolute value difference in terms of equity investments that the insurance and pension funds have in Europe compared to the United States is 1 to 3, if you look at the composition of the equity investments, insurance and pension funds invest mostly in unlisted shares, which tells you also what is the kind of deals and transactions that go behind the scenes that are not very much perhaps market driven. So we could talk about this a bit more about the governance issues and so on, but tells you that there is something dysfunctional and how equity investments take place across the EU. This again is the picture of the efficiency indicator. We have built this indicator which is essentially turnover over market capitalization. Again, the EU scores even behind China. This is a very interesting picture, which is the asset management industry. Just to give you one chart, because I'm already overloading you with all these charts. This is Europe. In Europe, we have essentially about 33,000 investment funds compared to 7,000 in the US, 4,500 in Japan, and 1,000 almost in China. 33,000 investment funds. The average size of an investment fund in Europe is 186 million. The average size of an investment fund in the US is 1.4 billion. This is a sector where economies of scale is what matters, because you have to put together liquidity and then you allocate this liquidity. The more liquidity you have, the more bargaining power you have, the lower transaction costs you can transfer to investors. And in fact, it's not the case. The European investors pay at least 1/3 more than US investors in terms of transaction costs for investment products. And here, I think the main reason is that our distribution channels, so the way investment products reach investors, are all very closed. from France to Netherlands to Italy, Spain. Mainly the role of open platforms doesn't exist. You mainly have banks selling the products that give them a retention fee that is high enough. And not all asset management industry can provide products if they don't have a higher retention fee for the local distributors. So they are essentially closing the market down to the investors. So I hope I gave you the efficiency dimension of the Capital Markets Union. Let me give you the coefficient dimension. And the first thing I would say, and Luis, you stop me or give me 5 minutes when I'm 5 minutes away from the end, because I think I lost track of time. I would like to make a distinction. We have said Capital Markets Union is not banking union for at least 4 reasons. First, it's applied to the whole European Union, so it's a multi-currency area, as I explained at the beginning. Does not require the creation of new institutions. So you essentially take the current institutions trying to build a strong framework around them, and we'll talk about the role of ESMA perhaps, how can be strengthened. You don't have public risk sharing. You don't have to create a public funds. This is purely private sector integration. It doesn't have trigger events because we don't have a European market. So you don't have a Cyprus, you don't have a Greece that is pushing you to do the resolution funds, to do the other mechanism that we have seen. So to some extent, it's a different story that has to be tackled differently. And it's politically more difficult to put in place because you don't have the market pressure that you are seeing for banking union. So the vested interests at national level are pretty strong. So the way we identify the barriers, because again, in order to reach this integration, you have to remove the barriers that stand on the way of capital markets integration. We have looked mainly at three areas. Information flows, so information about the underlying assets that can also be not necessarily an index or an asset, but can also be a company. When you buy a share, the underlying asset is the company value. And information about the financial instruments. So you know the issue about creating one single tape, for instance, for pricing of instruments. The second area is the execution, so the ability to access markets. This is very important. The third and the most important element for market-based funding, it's not price discovery, it's not execution, it's enforcement. The fact that you deal by definition with a plethora of agents, if those agents are not empowered with the private enforcement ability to hold you accountable if you don't pay, that will reduce the incentive ex ante to enter into a transaction. That's why in Anglo-Saxon legal systems, where you have a market-based funding role, there you have stronger public and private enforcement. Then we wonder whether it is strong enough after LIBOR and after what we have seen, but you know, it's generally stronger than in civil law legal systems. Now, what we look in these three areas, for price discovery, we look about data. And what is most important is the comparability of the data. If data is not comparable, I cannot compare a Dutch firm with an Italian firm. I cannot build sectoral benchmarks that allow me to make pricing of of financial instruments. And the problem is, what I wanted to highlight is that the fact that you don't have comparability increases the inability to predict cost. A capital market transaction, as you all know, is a transaction which you discount a future cash flow. So you need to have all these pieces of information on the future cash flow that you discount, and you have a price, and then you can go to market and say, this is my price, you have another price, let's come to a transaction. And all elements in this report, we highlight all the elements that increase the unpredictability of the cost. So if you're unable to predict costs, you are unable to discount future cash flow. So you don't enter in the first place in a market transaction. Because the question all the time that you hear, but there is no need after all of all this, there is no cross-border transaction, so why we should remove these barriers? Well, perhaps it's because there are these barriers that you don't have cross-border transaction. There are elements of unpredictability, like insolvency proceedings. in some areas that are so unpredictable that block any investors to invest because they don't know when they will get out of the transaction. Again, liquidation is very important. In an institution-based funding like traditional credit, traditional banking, the banks has a so big cost structure that can actually face information asymmetry. It doesn't care if you don't give them information. They have so much of investments into information in risk profiles and so on that can give you anyway a price. Markets won't give you a price if you don't provide this information. So, when we look at these three areas, we focus mainly on those areas where you see this unpredictability. I won't say much about the execution because I think you can focus mainly on two main areas. The distribution channels, they're very closed. Marketing rules for investment products are still very national. And if you speak about this with French authorities, with Dutch authorities, the answer is no. We are not going to harmonize these marketing rules. But the problem is that we look at them as individual dossiers, not in the bigger picture of risk sharing that we're talking about here. So that is a big problem that has to be faced. I think the most important issue in the execution area. I won't take much time on this. What I think is very important, 5 minutes? Okay. What is, I think, very important is the data comparability. And I will stop on only one issue, even though in the report we discuss, I think, 16 different issues that you see in the information flows. Just one, which is the use of internal models for evaluation of assets. I'm fine with internal models as long as you provide a uniform interpretation of definitions across the EU. At the moment, you have a definition on lifetime losses. So when you have a lifetime loss for a bank or for a company, you have to write that off. And so you essentially have a loss that has to be absorbed. The definition is you have a lifetime loss under IFRS 9 when there is a significant increase in risk. You can imagine how the interpretation of all the national authorities went on this. I mean, with the Italians interpreting it in a very large way, and as well other countries, the Germans or the Dutch going a bit much tighter on it. So you can see that they went all over the place. And you had, and the ECB was forced at the end of 2014 to essentially hire about 5,000 consultants to rebuild again the old valuation models of every bank and reevaluate every asset from the scratch. Because of this type of definitions. And what we also find out from the literature, that in accounting standards in particular, it doesn't matter if you harmonize rules without harmonizing enforcement. And you see the positive effects on liquidity, according to many empirical studies, only in those countries where the enforcement mechanism is strict, not where the IFRS has been introduced or transposed. Because it makes no sense if you transpose it and then you enlarge the definitions so much that you make them so loosened that it makes no sense. And another picture to give you just a sense of how it's becoming a bit ridiculous, this discussion, is today we don't even have a European business registry. Today you have 28 business registry, so even if you have to register your company, you go to your own, they will charge you a fee. These business registries don't talk to each other. If you want to know about an Italian company, you have to go, basically you have to go to Italy and get the information. Because they don't even have, I think until a couple of years ago, they didn't have an online database. You don't even get it online. And it costs you quite a lot. In fact, there are proprietary databases that are building secondary database based on this information and making also a lot of money. So this is an area where this information should be free, almost free. Because this information, basic information, that should be available to everybody, to every investors at any time. And again, this is also something not politically difficult to implement, because this is run by association because of the legacy of having this business registry since before the introduction of the European Union, I would say. So, I mean, let's say that here there can be done more. There's more to be done on accounting standards for listed companies and so on. But let me close with the last area, which I think is very important. The most important piece of actions for a European institution should be in the enforcement area. In the enforcement area, we essentially identify 7 out of 11 barriers that require immediate action, because they are really stumbling blocks to capital markets integration. Among those, in a very broad sense, is the quality, broad category, the quality of the implementation of EU rules, which is pretty poor. The judicial review, you'll be surprised that the quality of the judicial review in Northern European countries is not as good as many claim to be. And there are some interesting data from the World Bank on that. The sanctioning powers are pretty weak in some countries where you only have poor administrative sanctions. So the difference, when you have a EU passport and you don't harmonize sanctions, there is something wrong. There is essentially something wrong. Now, in this area, of course, you have a list of 13 policy recommendations, but I focus on only 2 of them. And what I think is very important is to discuss the role of ESMA. Now, we don't need to be the SEC. I don't think there is any political will or even need to become the SEC, to become a full-fledged federal authority. But the current peer review model is not working. And an example of it is Article 17 procedure for breach of EU law. In 6 years that ESMA is functioning, there's been no one case of breach of EU law. So you would be amazed that everything is working so well in the implementation of your rules that you don't need a procedure like that. But sadly, I was explaining yesterday night, last month the ESMA published a report saying, look, we recognize that half of our financial authorities are unable to recognize investment advice. If you don't recognize investment advice, you're actually perhaps not enforcing suitability tests under MiFID. You are enforcing, sales practices supervision over banks, over other institutions. So you're perhaps breaching EU law? No? So, do you see this constantly, these contradictions in what, comes out of these reports and what is the reality. So, and you know why it's not working? Because, first of all, the management of ESMA doesn't have any voting rights. So it doesn't really have any governance role. It's a sort of bit more than a secretariat. It's appointed by the Board of Supervisors, which are all the 28 financial authorities. And in this procedure is the chairman who is appointed by the Board of Supervisors who has to start the investigation himself. So the law is pretty clear. Has to be the chairman, so with a couple of secretaries, build an investigation against the member states, go to the Board of Supervisors and ask, sorry, can you approve procedures against yourself? And even if they are so crazy to approve it, then of course it has to go to the European Commission, who can only then issue a regulation that will immediately apply at national level. So you understand that this is not a governance that is working for the EU-wide interests. It's not a governance where the management has a real role into the definition of European policy. And the second element is the external dimension of ESMA. We had a review of the auditing regulation. The auditing regulation, where auditors are perhaps the most pan-European institution and company that you might even think of. You have KPMG, PwC in every country. They are all the same. But we were able to introduce 28 supervisors for auditing companies. This is a role where ESMA can actually easily step in and become a European supervisor. It is already a supervisor for credit rating agencies and for trade repositories. So what is taking so much for them to become supervisors of CCPs, ICSDs, these institutions that are already pan-European? And as well in accounting standards. Again, the interpretation of accounting standards in the US is made by the SEC, by the federal authority. There is only one interpretation of accounting standards, not 28 interpretation of accounting standards. I won't discuss about insolvency proceedings, which is another huge area of potential harmonization. Just let me conclude with one snapshot. We've discussed about financial stability issue. This financial fragmentation that we see is also caused by the lack of market-based funding to complement market banking, traditional, I would say, institution-based funding. Cohesion. We are, at the moment, the only political project that we are discussing for the euro area to push it forward is the finance minister. Is anyone in this room that believes that it's something that can happen in the next 15 or 20 years? I don't think so, because all ministers of finance will never give up all of these competencies and fiscal revenues and issuance of debt to a European commissioner, kind of European commissioner. So the only alternative is, again, after 60 years, is the single market, because it's the only place where you can actually get that impact, immediate impact in terms of risk sharing. And I always, even in this case, I think the US is an example, not necessarily to follow, but at least to understand how this process goes. In the US, before the expansion of the federal budget from 1% of GDP, as it is today in the European Union, to 30% of GDP, it took like a great recession. It only happened in the 1920s, almost 150 years after the creation of the United States. It happened after an important barrier removal plan for this US single market, which is called Sherman Act, which opened up the market in an area where barriers were not coming from regulation, because regulation only arrived in 1933. The US was tabula rasa in terms of regulations. It was foreclosed by behaviors of monopolists like Standard Oils or railway companies and so on. The Sherman Act, with the Supreme Court cases of the beginning of 20th century, have essentially created a single market, have abated barriers and pushed the integration of the private sector, which led to the confidence and trust to create a strong federal budget. In Europe, we are doing again, as we did with the euro, we are doing the opposite. We're trying to create a fiscal backstop, and which I think is good for banking union, but for the rest, I mean, additional fiscal policy coordination without having integration of the private sector, without having a market-based mechanism of redistribution of fiscal revenues, because that's what it is, private sector integration. You are creating a market-based mechanism for the redistribution of fiscal revenues. We are only focusing on the expenditure side. So now we deal with how much should we spend and where should we spend our money. So again, and this links up also with the empirical findings that tell you that 80% of the risk sharing doesn't come from public transfers. It comes from private sector absorption. So if you don't have a strong private sector, an integrated private sector, most likely your ability to withstand crisis at European level is pretty much impaired. And so I think on this note, I would say that this is more or less the view I would like to convey. So if you have any questions, I think we can get to there later. If you want to download the book, it's available here. Thank you.